Hi, everyone. Welcome to the Akur8 Academy's webinar. Today, we'll be presenting webinar from the Akur8 Academy. I don't know if you heard about it. It's an academy from Akur8 software company that it's meant to share and promote technical knowledge on pricing. So today we have the topic from technical knowledge to commercial decisions in pricing. And before starting, I would like to introduce Thibault Imbert and Mónica Carvajal-Pinto. So maybe it would be great, Thibault and Mónica, if you can present yourself before starting the presentation.
Okay, maybe I can quickly start. So, hello everyone, my name is Thibault. So I'm Senior Insurance Solutions Manager at Munich RE, supporting Munich RE client on their primary insurance operation with a core focus on, I would say, product and pricing and generally speaking, actuarial related topics.
Hello, I'm Mónica. I'm actuarial data scientist in Akur8, and I work supporting our clients in the use of our software in order to make to be more sophisticated in pricing. And particularly, I work in the APAC region. So yeah, I hope you enjoyed the webinar today.
Thank you for the introduction. So now I will stop sharing my screen. And I will ask Thibault to start his presentation. Thibault, you're muted, just in case.
Okay, yeah, okay, thank you. So let's start with a brief introduction on technical price and pricing generally, and particularly on technical pricing. So here the idea is to give a bit of context on how we see pricing, why we think it's important. So if you look at this slide, we can think, okay, pricing, it's about giving a price to the customer. But no, yes, but what we say, the pricing value chain is more powerful than that. And pricing is, I would say, about steering, first and foremost, a steering tool. Here are a few examples of business steering. First, what can be done? So understanding the book composition, the expected profitability, because if I have my risk premium, I have my pricing, technical pricing, I'm capable to derive some expected KPIs. We will get to that a bit later, and therefore understand the kind of the quality of my book. Of course, this also can be done at the customer level. So I'm able to understand the risk level of each and every customer and potentially link this with their behavior. What can be done by doing this is also that based on this, I can understand, transform my portfolio, change the composition, and also this can impact the underwriting process. If we need for certain client more questions, for example, to better understand the risk, that could be something. And then by pricing, I'm capable to really also have a proactive steering approach where I am capable to also derive some expected impact in terms of volume or profitability of my book. So this is the idea. So as I will say, pricing is about pricing, but most importantly, pricing is about steering, business steering tool. So very briefly, that what is the impact in terms of number of improved pricing? Here, what we can see is, I would say, we have kind of a case where we have two brands, so Audi and BMW. Everything similar, so same premium, same volume, but different technical premium. So Audi being more expensive than BMW. Here we can see that, therefore, we are cross-subsidizing the book and we have an overall combined ratio of around 90%. But then let's take the example that we try to have a proposed premium that is in line with the technical premium. So instead of paying 500, Audi customer would pay 600 and BMW customer would get a 50 euros discount. Of course, the volume will be impacted. So there are a lot of techniques to assess this impact. So here, if we have something very rough, we assume that we lose half of the book, but we gain on the BMW because we are more competitive. And generally speaking, by doing this, we show that we are capable to improve the combined ratio. So, and therefore, the bottom line. So this is really the idea. So the overall profitability will improve. So here is quite a simple example on how improved pricing can be used to improve the KPIs. So usually what we see is when we talk about pricing, and what can be seen is usually looking at the one ways. So I look at my KPIs, I look at loss ratio, frequency, severity on one variable. This is usually the approach and the first step. So this is something that has historically been done. The only issue with this is that even if it's quite easy to implement, it's something that is well known, is that it can be distorted due to correlation between factors. So here I took an example. So we look at the frequency, driver age and car age. And we see that the frequency, as we know, is higher for young driver. And we also observe that it's higher for older car. So we could think, okay, I need to load my young driver and load my higher older car. The thing is that in some markets, so this is an example taken from a market where young drivers usually tend to drive older car. So there is a correlation. In this case, I may over amplify the effect and I need to really understand what is driving. Is it the age that is driving the frequency or the age of the car? As we can imagine, if we investigate a bit more, we will see that it is the age in this case. Here, we really have to be capable to address this correlation aspect. Also, what can be done can be limiting is how to assess the interaction impact. So typically, that the gender effect may be different across different levels of age. Seeing this like this on a one-way analysis, it's not necessarily sufficient. So we can end up having two ways or multi-ways on the way we visualize it, but really that very quickly reaches its limitation. So here our approach is usually to go to a multivariate approach, typically GLM, GAM model, as we will see in the next section. So multivariate is, to summarize, is that really then we are capable to get variables to kind of talk to each other, decorrelate, and get the overall picture. We have the different perspectives here, which would be the univariate way. The multivariate helps us to really bring us what is really about, and we get this size, this kind of cone-shaped items rather than squares and circles. So we really understand how the risk is being structured. What is usually being done? So if we talk about risk modeling, which is then used for pricing, simple example, what we would do when we run our multivariate analysis would be to choose an appropriate level of granularity. Can be from the product up to something at the peril and frequency severity level up to propensity. So these are the different things. So we can have also the cover, TPL on damage, the peril, TPL bodily injury versus material damage, attritional, the excess, and looking at frequency and severity. So this really depends on market considerations, data consideration to really decide. But this is the approach on how it is usually being done. So what the purpose is, as well as saying, is to much more than simply giving a price. In the previous slides, we mentioned a lot this concept of technical price. and that is derived out of the modeling. So here is really how we usually derive our technical price, so from risk assessment, loading, and expenses. Technical price is, we define it as the compass. So the way we see it is there is the risk view and the commercial view. So the technical price is how much should be charged, commercial consideration, real life consideration, then enter into picture and give commercial and potentially actual premium. Still, it is important to know it because then we are capable to also get actionable insight, as we will see later. So we have our technical premium and our actual premium. And what is important is to be capable to understand how do we move, how the commercial and the technical world, I would say, move together, and how does the technical premium can also take into consideration, for example, regulation, distribution, all of these aspects. Then what I was mentioning also was that predictive, so pricing is here to steer the business. So generally speaking, all of these predictive items are here to steer the business. Here is an example. So basically, I have my historical database on which I can observe each and every policy, and I can derive some general models, so some models to detect the patterns, so typically GLM, to build the predicted model, so risk model, for example. At the same time, I also have my book, so policy in force, which are here, which can potentially be renewed. Some new may be converted also. They will age. So I'm capable to, based on my present, also see the future. And by combining what we say past, present, and future, I will be able to predict because I know what my book is at the moment. I have some expectation on how it will age, how the mix will evolve, all of these things. And I also have the patterns, so all of the modeling part and technical premium risk, technical premium aspect to really capable to predict the different KPIs on my book and take business decisions which are relevant from a technical perspective. This is the idea. On top of that, also, so this is what I can do. Some people may say, yeah, but I only have my observe, so I can just have a look at what I have now in my portfolio. I don't need this modeling part because I can simply say, okay, I see that my frequency is high. I increase the deductible, or I have a high loss ratio. I push up. Yes, that's the idea. The thing is that the observe part is, of course, very important, but we also need to go beyond this observed KPI and go more into the expected KPIs part to improve the relevancy of the process. Here is an example. So I have my observed loss ratio, and I see that I have something stable that goes a bit up with age. But then I start seeing volatility and I have limited volume. Could say that I have still enough, but I really see it's fluctuating. Does it make sense that I have this drop and then up again? Here I have pretty much nothing. So I have a very limited exposure and I have a loss ratio of 0 for the simple reason that I have been lucky, let's say. So it's really that because the exposure is so small, probably not yet developed. So what is really the performance of my segment, of this luxury segment at the moment? So the idea is let's use instead expected KPIs. So with models, also add what is the paid, the commercial premium paid by the customer. So how much money was collected to be capable to derive some expected KPIs. And here I could see that, for example, I'm expecting something still increasing a bit and reverse stable when it comes to all cars. The same way I realized that my luxury thing segment is actually have a higher expected loss ratio. Maybe it's been heavily discounted to start to grow this segment because it was quite small. And therefore, now I don't have a claim, but in the future, I can really expect higher loss ratio than what was planned because of the discount. And then I can anticipate and I can potentially re-engage with distribution and underwriting to understand what is happening and anticipate. So really, the idea is that we support, we anticipate the decision-making process. We try to make it as relevant as possible. So now that's it for the overall context, I would say. I will pass the control to Monica. We will enter more into details about how do we get to this, how do we build the models, particularly when we have this constraint of regulation, for example. Monica, you should be able to share your screen.
Okay, so as Thibault mentioned, now I will go more into the details on how to actually build these models and some examples of commercial decisions that could be taken in a regulated market. So starting from the creation of these models, I would like to just as we have said, the idea of the technical models, in particular of the unconstrained model, is to separate from the data what is signal and what is noise. So, for example, as Steve also mentioned on his examples, you might have something like this if you only look at the observed, but we cannot say that there is a difference for each age of the driver, that we are looking at something totally different. So we might want to smooth this and separate the noise. For what is the idea is not to find what is the tariff I will use in the market. The idea is to have the best estimation of future losses. So going into that direction is very important, and the recommendation is not to look to aggregated data. So, for example, here we have an example that imagine in your tariff you have the age of the vehicle, and for some reason you have some predefined groups. That is how you get your price. So you go from new cars to 2 years old, from 3 to 6, 7 to 10, or older than 11. If you go and you fit a model using these predefined groups, you could. However, we will never know what is happening inside each group. And this is important because if you group them and then you forget that you grouped, you will be assuming that cars that are new or cars that are 2 years old have the same risk. You will be making an assumption, maybe without notice. So the idea, since we are looking for the best estimation of the future losses, the idea is to actually question that and see, are they really the same level of risk? So for example, here, if we go on the same graph, but now we saw the raw data. So we go from this view that is aggregated, where our predictions are quite close, and to the view where we now separate each level. We see that the prediction we are given is the same. However, in the observed, we see a difference between new cars and 2 years old cars. So this difference, we won't see it if we only aggregate it. So it's just to start for creating this unconstrained model, the ideal is to have all the levels of details that you have in your dataset. So after we prepare the data, what we will have to do, we will have to see what are the variables that we have available. This might depend on the line of business, of course, but what information your company has been recording. But from whatever we will have to create models to make predictions. And what is the step is that's coming is we will need to decide which of these factors to use and how to use it. So, of course, this might require some technical expertise. It's not obvious. As Thibault mentioned, there might be variables that are correlated. So it's not just to take the first one that have more correlation with the target. It's a process that involves to build this project. So it will do this following a manual approach. And our goal is to have the highest performance. So I want to be as on this axis. We might start with a set of variables. Maybe there are a few variables that we know that we will always use. And then we will start trying to see what are the next one. And maybe we will have to test some options that are not good. So we will have to come back. And this will require multiple steps and a long time, because we will have to be testing from the list of variables available, different factors, potential groups of the levels, what is the right shape of the coefficient. So, of course, this required a long time and might be the reason why some companies don't do these technical models, or they don't update quite often the models. Okay, so what we promote in what is our algorithm in Akur8, we have a unique machine learning algorithm that will automate the data-driven part of the process. So wherever you can extract from the data set, the idea is like our algorithm will find it, and then the user will have to just set which are the options, what are the variables available, and then review the results, of course. For example, the case that Thibault mentioned, you have a low exposure for some type of cars. That is not something that it will be driven by the algorithm, it will be driven by the expert, but there will be other patterns that the algorithm could find in an automatic way. And of course, the process doesn't finish only with which variable to use. Then you might consider some interactions between those factors. Optionally, if you have also access to the location of your clients, you can incorporate where are the postcode or any city where they live. So on any option of external variable that your company might be considering, for example, geospatial data set, more information about the cars, etc. Everything could be automated by the algorithm. Okay, so just to summarize, it will always be a mix between the automatical part from the algorithm and the software, but the user will also have control and could interpret the results factor by factor. Okay, so I won't go on all the details of this, but from the next part, I will assume we have created our technical models. Okay, so after the creation of these models, the question is how I will use this in a regulated market. And just to give a context, in general, in any market, not only on the strongly regulated market, it's very weird that you will directly use the unconstrained models in your price. There will be some steps in between. There will be some constrained models in between, or any other commercial decisions. So just to say some, for example, it's very common to exclude the gender in the final rating tables, and not use it as an official rating factor because of the regulation or because of the company decisions that that factor is not used in the final price. In some markets, if we go to other extremes, In some markets, especially the tariff for motor third-party liability is fully regulated, and the option of adjusting the price is not there. So the companies might have to do something else, not just adjust the price. In other market for own damage, also for motor, is also regulated. However, there is some flexibility on some regulated market to make some adjustments, or maybe to apply some discounts to the official tariff. Of course, health insurance is regulated in many countries. Also, other points is distribution channels. So it's not something related to the regulation, but it's also a constraint. Maybe different distribution channels will have different access to information. Maybe you ask the postcode, some channels might not want to ask that to the client. And also, of course, there might be some strong market standard that maybe you don't want to be the first one to change everything, and maybe the tariff is fixed, as in some country private insurance is, where they don't ask many questions to the person that is going to buy insurance. On top of this, of course, there might be something internal in the company that is maybe for the direct channel, you have more freedom to personalize the tariff and update it. And maybe, as we discussed before, maybe for some company values, you want to exclude some of the factors. So just to give you an idea of some comments we had heard in different regulated market, we have, for example, some of these are very specific to some countries. In Japan, you have that you cannot move more than 12.5% from a reference premium. Maybe Thailand, I can only move the base level. Maybe India, I can only apply discount. I can only move 10%, maybe something more related to Malaysia. Agencies don't want to add more variables, that is maybe everywhere. Maybe I'm not looking to change my price. I cannot change my price, but I'm looking for where I will apply my marketing campaign. There are different reasons why I won't directly apply the unconstrained models to the final price. So, as we discussed before, the process is from the variables we create the models to make predictions, but in regulated market, of course, we had to add the regulations, the IT limitation, and what the agencies might say. So you will have to build an unconstrained constrained version of the models. That this difference will be probably bigger than in other markets where only a few factors are excluded from the final tariff. As Thibault said, the idea is like this unconstrained model that we already built work as a compass that is tell us in which direction we should move if we want to have better predictions and have models that are closer to the real risk. So in the same graph that we saw before, if we have the performance, so the predicted power of these models, and in the other axis we have the variables, maybe our current tariff doesn't involve many variables. And of course, the predicted power is not the same as an unconstrained model. But we will know that this is the direction we want to go. Potential actions to do. Of course, it will depend of the company. It will depend on of the regulation of what the company is willing to do also. But here are just some examples. Of course, in any case, you always will have a better understanding of the business KPI. You will be able to identify the profitable and unprofitable segments of your portfolio. You want, given that view of the profitable clients, you might localize your marketing campaign or the location of your sales offices if you know in which sector is more profitable. Of course, maybe you won't change directly the pricing decision, but you might take underwriting decisions related to this. And of course, you might apply discount to some segments if it's possible in your market. On the other side, of course, if it's possible, you could adjust the current tariff. And there are different stages to adjust this tariff. It could be that you adjust it using the same rating factors that you are considering. And if you have grouped some of the levels, maybe you want to keep it. Or maybe you want to use the same factors, but you are willing to redefine those groups. As we saw for vehicle age, maybe the groups that we show in the example were not the best, and we might want to use different ones. Or you might want to add new rating factors, or of course, move to a new pricing structure. Okay, it's of course, we don't expect that companies will move in one step and will change everything, but it might be a path to sophistication. So here there is an example of more like how to do this analysis. This is what we call the gap analysis. On one side, you might have your current tariff, that it might be a set of rating tables given by the authorities, given by your company. It doesn't matter. The important is that you have a base level and you have a set of factors that you use, you multiply, and you get your current tariff. On the other side, you will have the expected losses that come from this unconstrained technical model. So we might use this feature, let's call this location analysis, that is, of course, used a lot in the US market, but also everywhere now, where you might want to understand where is the gap between my current price and these expected losses. So the first thing you will see is the average difference. That is something that you could also see in other tools. You could see what is the current tariff you are given, where are the losses, and what is the loss ratio in average. But the idea of this feature, of this tool, is to understand why and where these different come from. So removing the margins and other expenses, of course, because they might be a different, because not because of the risk, because the margin you are expected, or the expenses of some channels, etc. But what is the difference for each person between my current estimation of the risk and the unconstrained risk? So for this, you might calculate that gap for each single person in your portfolio, and then you might have a view like this, where for some people it's zero, so basically it's the same. For other people it's higher, so basically the risk is higher than what you are predicted, or for others it's lower, so maybe you are over predicting the risk in some segments. This is just an example, but I will show just to illustrate what is possible to do with this feature. So after you had seen the difference in this histogram for all the individuals in your portfolio, then we would like to know which variables explain this difference. So basically why and where are not given a price that is following the unconstrained models. For that, with this tool, you will be able to do an automatic analysis where, of course, again, the algorithm can sort all the variables that you have and tell you which are the ones that better explain this difference. In this example, these are the variables that come out first on the list: driver age, vehicle age, experienced driver, payment delay, duration of ownership, gender. For example, here just you could take driver age. I just skip driver age in case it's not something that you would like to modify or it's not something that you currently have in your tariff. It could be the case that I went for vehicle age just because it's more common to see it in the tariff. But the user might select which one to adjust or which one to go and look into the details. But the algorithm will tell me automatically which are the one that better explain this difference. After that, also the algorithm will tell me what are the suggested rate change. So the algorithm is telling me you should increase a bit the price for new cars, decrease for 2 years old, increase, etc. And particularly, I see here that for all cars, I should decrease the price. This is just an example, and remember that in the tariff we were grouping from 11 or plus. So maybe we were considering that 11 years old car have the same risk as 20 years old car or even older, and maybe that wasn't the best assumption. So now, given the unconstrained models, we can see that gap. Okay, so we could see this for any variable, just to explore the difference and see that indeed, if we plot for vehicle age, the average premium without the margin and the average losses, we see that here are the groups that we discussed before. From 11 or plus, we are given the same price, but maybe we shouldn't, and the same on each group. And then we plot the loss ratio that we are having for vehicle age. We see that the loss ratio is higher here and low here. So thanks to the algorithm, we can automatically spot this without having to look into all the variables, all the possible segments, and we can have a clear visualization of the losses and the loss rate. Then, if you have visualize this, why is this so important? Is because as we described in the first slide, if we are given the same price from new cars until 2 years old cars, this is there is a risk because the real losses are higher for new cars and lower for 2 years old cars. If nobody in the market will change that, maybe we are safe, but if a competitor start to differentiate the price and giving a lower price to 2 years old, maybe we will lose those clients and we will only keep the new cars that will have a high loss ratio in the future. So it's something we have to always be aware and then decide which type of decision to take based on that information. So here, in order to describe some examples of which decision you could take, given that you already know what is the situation, we list something here that we put our current tariff, and we will adjust that in different ways in order to have our final price. So one option is that you actually, as we saw for driver age, you redefine the groups, or you stop grouping the levels and you define this in light green new prices for them. Another option could be that maybe the algorithm is showing you that there is a factor that you are not using and you should use. For example, if the driver had experience or not. Okay, this is just, of course, only if in the market is allowed, or maybe you need to negotiate with the regulators in order to use it, but the algorithm will tell you which is the factor to add. Maybe, as we had here in some market, maybe you will just adjust the base level because it's what the regulation allow you, given a minimum or maximum. You might rebase that. This is based in some markets where you cannot change the tariff, but you might want to apply discounts. If in the map, you know where are the profitable and unprofitable clients, you can decide where exactly in your territory you want to apply the discount and which are the discounts that follow the risk. And then you decide what are the real discounts you implemented, maybe following other reasons, not only the risk. For any of these cases, you might need to test different scenarios. So if I just adjust the price, option 1, option 2, and you might need to, you will need to see the global KPIs. As Thibault explained, this will have an effect in the global KPIs. So you might want to compare what is happening if I don't adjust anything, if I make the first suggestion of adjustments, the second suggestion of adjustment. And the idea is like our tool could facilitate that analysis in the same tariff. You could propose different scenarios and then compare the results. Okay, so this is the process. If you want to have full control of each process, you inspect a spot where is something that you could adjust. Then you might want to adjust any of the options we show or something else. And then you will visualize the global KPIs and maybe go and make a second adjustment. In any of these steps, we remember we are trying to follow the unconstrained model as our compass. And there might be different ways to achieve this, but also you can use some automatization to do it, keeping the same groups you have, maybe redefining the groups, or maybe adjusting, adding other variables to your tariff. You define the level of freedom that you might want to have, or maybe it's not you are choosing, maybe it's the market that is telling you, but then in the tool, you could compare the results and adjust your price given the flexibility you might have. So just to conclude, just to be clear, the unconstrained models are useful in any context, and grouping information or not using some available information might only hide a situation that is happening. It's just we won't see it if we don't analyze it. Keeping the transparency is key to avoid any adverse selection, as we described, that if we give us the same price to some clients, we might be losing the good one and just keeping the bad client in the future. And all these models can facilitate our commercial strategies depending on each context. And we hope that these technical resources are your compass to do any tariff adjustments or modification. So that is what we would like to share with you today. Thank you.
Thanks, Monica. And thanks, Thibault, as well. So we have several questions in the chat. We'll try to answer all of them. We have 12 minutes. It's a bit challenging. So I'll start with the first one that it's for Thibault. So Thibault, on page 9, I don't know if you recall, there is one question. So it's how does predictive modeling help explorate segments with very little data? Example, the luxury cars segment sample.
So it can give a guidance, I think. So how we can explore is usually we may have something out of the modeling, you know, by playing with it, expert judgment, what we may see, but we don't necessarily see it on our current portfolio. So that will help us. That's usually the idea. We have something that is particularly using Akur8, you can take into account the credibility. So that is probably closer to the average that we need to decide. We can potentially analyze a bit more, but at least we are capable to get an investigate about it. There may also be the fact that it's, for example, older drivers, which are considered different ways. So by bringing even if we have less data, we don't have much data, we can still do it, I would say, first by expert judgment, and also it will bring a bit more to the observed than the observed, because there are also the multivariate aspect that can enrich on this. Okay, so I have little, but it's mostly, I know implicitly, older drivers. What can I expect from a loss ratio perspective?
Thank you, Thibault. So we have one more question. I think this one is for you, Monica. If the model with the vehicle age grouping has a better Gini coefficients than a model with the raw variables on an out of sample data sets, would it be fair to say that the grouped variable provides a better estimation of future losses?
Thank you. Well, to me, it depends if the out of sample is looking at the ungrouped data or the group data. Okay, if in out of sample you are looking at the ungrouped data and you have a better Gini, yes, why not? And the idea of the algorithm is like you start with the ungroup, and if necessary for a statistical reason to group, the algorithm will group automatically. Okay, so it's not like we say that you shouldn't group, it's just that you shouldn't group without looking into the data.
Okay, thank you. Next question. In some situations, the technical model will imply a large rate change for a large portion of the book. This will lead to a change in the portfolio mix after the model is deployed. How do we model that change so as to manage the risk of the change of mix? Example, impact to the short-term financial result.
Mm-hmm. Yeah, maybe something that we didn't mention in this presentation, but of course, any rate change that is large, we don't say you should apply it directly. You should always be careful. And in terms of portfolio mix, maybe there is another input that we didn't discuss today, but is the demand of the conversion or retention models. So if you also use this algorithm to build to know what is the probability that what will be the reaction of your clients given new prices, you could also put that into consideration, and all the KPIs we can show it in a dynamic way, also considering the effect in your clients. But for that, and maybe we didn't talk today, but for that you will need to also have some hypotheses at least, or some models. It depends on the context of what will be the reaction of your clients.
Okay. Thanks. So there are 3 more questions. On using constraints data, example, the data levels as is without grouping of levels. Do you recommend this for all circumstances? Example, sometimes we group levels up because the data could be sparse. If we look at individual age, let's say, instead of banded age groups.
I will take this one too. Let me see. Yes, of course, as we said before, the idea is not to say that you will fix the model at individual level always, but the algorithm will realize is, for example, in the example we show with the age, driver age, there was a peak of because it was one single level with many claims or large claims. The idea is like your model could not, the algorithm would notice that this is noise. So maybe I should look at the neighbors. As I said before, the idea is not to group the levels without looking into the data, but first look at the data and then you can find the best groups. Not use predefined groups without making a statistical analysis. Sorry.
Thank you. Okay, we have two more questions. With regards to these comments, so in quotes, each distribution channel might have different IT systems and different access to client information. So the question is, which approach would you suggest? Build a unique set of models only considering variables available for a specific distribution channel, or building a model using all variables and removing the unavailable variables via smoothing for a specific distribution channel?
I can reply this one. So usually what I would do personally is I would really differentiate what I call the unconstrained from the constrained world. So my approach would be to always start with the unconstrained. So I don't take all of these aspects into consideration at the moment. What I want is a best possible estimate of my risk. And then I would constrain. So I would layer a bit. I would not necessarily have all of the models. I would have one model that is the unconstrained. And based on this, I would constrain. So it can be done typically in Akur8, where I say, okay, I have my own constraint, and then I add my different model. Here comes, what do I want to do? I know what my constraints are. I cannot use this variable. I cannot charge more or less, either to change manually or to let the model calibrate. But you always, I will always start with an unconstrained. We can assume that this is the one which has the most variable. And then based on this, adding the constraint and on this model and let the model recalibrate, and then checking, of course, that it makes sense to have the different version. But that's really how I would stage it. And also I would keep this unconstrained model when we talk about expected loss ratio, for example. Here it's more the accuracy that is relevant, I would say, because I'm not using it externally. I'm using it more internally for my own internal KPIs.
Thanks, Thibault. And there is one more question. I think we'll make it on time. Could you maybe explain how the data set looks like you're using in rates to make these tariff adjustments to derive the final price, assuming you build the models on all matured historic data available?
Okay, so on the examples we show, what you need is, of course, all the variables that are used in your tariff are used in unconstrained models, all the variables that were selected, because not all the ones that you are available were selected. You also need the information of any expenses, loading, like all the things you need in order to calculate a final price. That is the data set. In terms of maturity, is usually not the same one you will use to build the risk. For risk, probably you will look to historical data, some years in the past, but for rate, maybe you will look at your final or your current portfolio of clients. And then how to do it, I didn't want to go on all the details because that will depend of the client. If the client have already a GLM in production, if the client have a table-based regulated tariff in production, all those elements could be bring together in order to create the final price. And then the different scenarios will be in the same project. You could play with different adjustments in the same project without having to create something different.
Thanks, Monica. And we have one last question coming in. Follow-up question. Most insurers will not have kept collected data about their demands at varying prices. How would such insurer hypothesis hypothesize the change in demands from their new price regime?
Maybe I can quickly answer on this one. So here, what can be done is also to take assumption on the elasticity usually. So you don't have this data, so you are not necessarily capable to measure the proper elasticity. So there is the option to have this elasticity assumption, which can be, I don't know, evolve also, I don't know, can be 2, and then can increase or decrease depending on the impact. Or if you still have some, I think that's the only one that's the thing. You still have the quote also, so you may have not varying prices, but if you still have the quotes, if we talk about conversion, you can also kind of have an elasticity, implicit elasticity along the price curve, or by doing this. So you don't have the pure elasticity that I change the price and I measure the impact, all things being equal, but still by having a lot, I can introduce my price and change of price as a variable. That can be a way, or I can also take a rough estimation on the elasticity. There is a bit of literature on this that can help to kick off which value should it be, and then values which are reasonable.
Thank you, Thibault. So we are on time, but if you have any questions, please feel free to send us an email to the email contact address that you have for the webinar. And yeah, thanks for coming. Thanks for your time. Thanks, Thibault and Monica, for the presentation. And yeah, hope to see you soon in another Akur8 Academy webinar.
Thank you.
Thank you.
Bye.
Thank you.
Bye.
Have a good day. Bye.